Recently, fears about rising inflation and interest rates have contributed to the extraordinarily unpredictable state of the market during the year 2022. And the month of June saw inflation numbers reach their highest level in 40 years, which caused markets to continue their downward trend. The S&P 500 index saw a brief correction on May 20th, but on June 13th it went back into a bear market. So, are we in a recession already? What should we do? And how can you even take advantage of it? Hello and welcome back to Crypto Cash Channel. What do you think about the market crash? Is this the perfect opportunity to get rich? In today's video, we look at how the biggest market crash of our generation will turn out and how you can help yourself from it. But, first, before we go on, a sub to the channel would be very appreciated. Comment, share the video, and don't forget to leave a thumbs up for the video. So, let's get into it. Despite the fact that looking back at history may tell us how long stock market corrections and bear markets often last, no one receives a calendar notice that states the time, kind, and predicted length of future drops. So, what exactly does it imply when the stock market has a precipitous drop? The most recent drop in the stock market took place in the early months of 2020, coinciding with the beginning of the COVID-19 epidemic. The change in the S&P 500 stock index from one day to the next might range anywhere from -1% to 1%. And anything that occurs on the stock market that falls outside of these parameters is likely to be seen as a busy day, regardless of the circumstances. And if the S&P 500 index drops by 7% in a single trading day, the index may be halted for 15 minutes. The fact that something like this has only occurred a few times in the past makes it an especially devastating event for Wall Street. Crashing happens when an increasing trend in the stock market, known as a bull market, gives way to a significant and unexpected decrease in the value of stock prices, which is known as a bear market. Even while several key indexes are getting dangerously close to entering a bear market territory, there are some experts who feel that the so-called fear gauge on Wall Street is a warning that equities still have more room to fall as investors struggle with the worst performing market in years. The CBOE Volatility Index, which is a measure of predicted volatility and is often known as the fear gauge, increased to over 35 points this month as a result of the sustained catastrophic declines in stock prices. And actually, investors anticipate an even worse sell-off may occur over the next months. Even after the worst quarter for the stock market in the past 2 years, many analysts are still uncertain as to whether the recession is already here with us. It is likely that the hazards may increase much more next year, as the Fed begins to reduce stimulus measures, which would signal even more negative news for equities. According to Michael Wilson, an analyst at Morgan Stanley, the sell-off that occurred at the end of the month on the stock market was especially vicious, and most certainly wasn't done as a result of the accumulating signals that economic growth is slowing down more quickly than anticipated. Wilson anticipates that the S&P 500, which has already dropped by 17% this year, may fall by a further 13% before it reaches its bottom. And what do other experts think? According to Shine's forecast, the market will hit rock bottom either when the Federal Reserve stops its quantitative tightening campaign or when inflation begins to decrease. So, what steps can you take to safeguard your financial interests now that a crisis in the market appears to be developing? First and foremost, you should be aware of what you possess and why you own it. No one should give up on investment just because they are concerned about a temporary drop in value. However, if you look through the notes you took during your first stock investigation, you can uncover some strong arguments for selling the stock. You should keep a written record of every investment in your portfolio, as well as the factors that would cause it to be placed in the out box, as part of your comprehensive study on the stock market. Your research will act as a tangible reminder of the characteristics that distinguish stocks that are worthy of ownership and serves as a form of investing roadmap. And because of the information you will have uncovered, you won't be tempted to sell a long-term investment merely because it had a bad day on the market. On the other side, it offers a justification for the act of selling a stock. Before you put money into the stock market, it is important to have a solid idea of how much of a risk you are prepared to accept in order to have a sense of how much volatility you are able to withstand. The ability to remain steadfast in the face of adversity and keep one's investments despite a decline in value is the single most important factor in determining one's level of success in the stock market over the long run. Secondly, you should place your confidence in a portfolio that is diverse. If you have investments in many asset types, such as stocks and bonds, you may experience a wider range of effects when there is a decline in the stock market. As a consequence of this, diversification is crucial for minimizing exposure to risk and guaranteeing a smooth ride despite the turbulence of the market. You should diversify your portfolio so that you do not have all of your money invested in a single category of asset. This will help you prevent losing all of your money. It's feasible that your other assets may make up for a bad day at one of your companies or in one of your industries if you have enough diversification of them. The most prudent thing to do in this predicament is to keep your cool and rely on the diversity of your holdings to see you through the storm. You will still experience misery in the short term, but in the long run, it will prevent your portfolio from suffering losses that are beyond repair. Thirdly, make sure you have enough money to buy the dip. When there is a decline in the price of an asset, it could be a good moment to buy. Consider it to be the equivalent of buying stocks at a bargain while the market is in a freefall. The trick is to have a plan in place for when the market crashes and to have some cash on hand to invest in assets that are currently experiencing a fall. However, what criteria should one use to determine whether or not one is prepared to buy the dip? First, you should already have money put away for emergencies, money saved for retirement, and cash on hand to cover the expenditures of day-to-day living. You should also have some cash set aside in the event that there is an emergency, and you have a running wish list of certain stocks that you are interested in purchasing. If you buy near the bottom of the slide, there is a chance that you won't obtain the stock at its absolute lowest price, but that's fine. The goal is to make the most of possibilities that, in your estimation, will be beneficial to you in the long run. After that, you should focus on the long term. It could be difficult for you to see the value of your investment portfolio decrease while doing nothing to reverse the trend. And if you want to invest for the long term, doing nothing is often the best thing you can do in the aftermath of a market crisis. Be conscious of the fact that if you sell your investments during a downturn, you are basically locking in your losses for the foreseeable future. Take, for instance, the financial crash that occurred due to COVID in February of 2020. Consider the example of an investment of $1,000 in an exchange-traded fund that tracks the S&P 500. The value of such a fund would have dropped by more than 30% during the market crash that occurred in the spring of 2020. And if you had sold, you would have incurred a loss of 30%, but if you had continued, you would have been able to recoup your losses by the month of August, and then your profits would have continued to grow after that. And if you decide to come back when things are more favorable, you will almost certainly have to pay a higher price and give up part or all of the gains gained from the recovery. And that's all for today's video. Thanks for watching. What have you done so far to prepare yourself for the coming market crash? And how hard do you think it will hit? Comment below. Let's engage. Also, if you are interested in more videos like this, make sure you like this video and subscribe to our channel. Don't forget to turn on the notification bell for more amazing videos. Goodbye. See you in the next video.